In this discussion, we will discuss the discussion question of describe the net present value method of comparing investments. If we see a discussion question or an essay question like this, our goal typically is to expand on the discussion question or essay question, then being more likely to pick up the most points. Within an essay question, we're more likely to touch on those concepts that are being looked for. Within a discussion question, the goal being to contribute to the discussion, and expanding on the topic is the way to do that. Keeping that in mind, let's go through this one more time. Describe the net present value method of comparing investments. So if we see this type of essay question, we might first start with the definition of the net present value method. What is the net present value method? That would be a good place to start. Note, however, if we want to expand on this, we could take a step back and say, well, the net present value method is something that's used in capital budgeting. Talk about capital budgeting. We could then take a step back and say, well, capital budgeting decisions are a managerial type accounting decision as opposed to financial accounting type decision, and go into the difference there. The difference there being financial accounting decisions are usually going to be based on the creation of financial statements, how to record something, as opposed to the managerial accounting, which is based on what do we do. We're going to use accounting methods to actually think about what actions we should take rather than how to record, in essence, those actions for the financial statements. Once we have the managerial accounting, we could say, well, this is the managerial accounting type decision of capital budgeting type of decision. And that's going to be an important type of decision, a little bit different than other types of decisions, typically take more time. Why? Because they're going to influence more times in the future, more time periods in the future. They can't typically be reversed, and they're usually of a higher dollar amount. Therefore, we're going to go through more of a formal process to decide what the capital budgeting type decisions will be. The fact that they do influence time periods into the future also means that we have to consider, or some of the methods we use should consider, time value of money. Then we could talk about time value of money. Time value of money, the concept that the current dollars are going to be worth more than later dollars. In other words, if we had the same amount of dollars here in the current time period or later, then the ones here are going to be worth more. Or in other words, if we had later dollars and current dollars that are going to be equal in value, then the later dollars we'd need more of them in order for us to value them the same. We could discuss why that would be and go into the fact that there's going to be actual deflation or inflation that's going to decrease the value of the dollar, and possibly an opportunity cost, the cost of what we could do with the dollar if we had it today, either invest it, spend it, get a return on it in some way. Then we can go into the discussion of the net present value as being a method that we can then use within capital budgeting. So the net present value method is one method that we typically use, one of the major principal methods that we use that will take into consideration the time value of money. That's going to be one of the key points of the net present value method. So you want to basically make sure to point that out. Net present value method is going to take into consideration the time value of money, and that's the point of it, and that's going to be one of the major advantages that it has over many other types of methods that will be used. How does it work? Well, we're going to have to set the discount rate at some rate, and you could discuss, well, how would we set a discount rate? It's going to be related to the time value of money. You could discuss a hurdle rate, how we would what a hurdle rate is, the minimum rate of return on an investment, and that's going to be the rate that we're going to use in order to discount the project to determine whether or not we want to accept or reject a certain type of project. And then we'll present value the cash flows using that discount rate. So for example, if we used a 10% discount rate, we would then look at all the cash flows that happened. We would present value them back to the current day using the discount rate of 10%. And then once we have done that, we can take a look at the total cash flows in terms of present values, in terms of equal value dollars, outflows and inflows, and we can consider whether the outflows are greater than the inflows. If we use a hurdle rate as the discount rate, then anything that's going to be positive, any number that is positive, means that we have cleared the hurdle rate. And so even if it was $1, we may want to consider doing the project, because that means that we got a rate of return at that 10%. So we're clearing the hurdle rate. And that's one method to use. If we had multiple types of projects, then we would look for the project that clears the hurdle rate and look for the highest net present value project.